Okay, let's unpack this. We are diving into a really complex investigation today. It's one that touches on, well, everything from sophisticated Wall Street financing all the way down to the basic availability of safe, affordable housing. Our subject is Avalon Bay Communities, Inc. I mean, it's a name you see plastered on apartment buildings all across major cities, yet it's a company whose inner workings often remain, pretty obscure.
And that obscurity is exactly what we're trying to pierce today. This is not just any landlord. Avalon Bay is the third largest owner of apartments in the entire United States. They're managing nearly 100,000 apartment homes. So to understand their decisions is really to understand a huge chunk of the modern housing market.
Absolutely. And when we talk about Avalon Bay, we are talking about a powerful financial entity. They're a publicly traded real estate investment trust, a REIT, and critically, a component of the S&P 500. This means their operations are under constant pressure to generate returns for investors, which, as we're about to see, creates this fascinating tension when you balance it against their obligations to renters and, well, the law.
That financial pressure. It means their strategies have to be aggressive and their reach is just immense. Their decisions don't just affect rent prices in a single neighborhood. They influence rental market dynamics across major regions. I mean, from California's dense coastal cities all the way through the D.C. metro and right into New England.
So our mission today is pretty straightforward. We're cutting through the corporate filings and the glossy property brochures to understand how this massive organization operates right now. We're focusing on two specific, very recent areas. First, their incredible strategic and financial maneuvering in just Q3 2025. I mean, a quarter that involved shedding over $500 million in assets while simultaneously investing hundreds of millions in new, very specific growth markets.
And second, and this is really the focus of our deep dive, is the growing stack of high-stakes lawsuits. They're currently challenging nearly every aspect of their business model. And these aren't just minor complaints, They cover everything from alleged large-scale antitrust violations rooted in algorithmic pricing to consumer fraud allegations about renewal premiums, and even some really serious housing discrimination claims impacting vulnerable populations.
Right. And we're working primarily from a comprehensive source overview for this. It tracks the company's decades-long history, the scale of its asset repositioning, and these current, very serious legal challenges it's juggling across multiple states.
The tension here is just palpable. You have a multi-billion-dollar entity executing these complex, calculated financial moves at the highest level. And at the same time, they're facing accusations of misconduct at the most basic level of landlord-tenant relations. I mean, when a company owns or holds interest in over 97,000 apartment homes, which Avalon Bay did as of September 30, 2025, the stakes are massive for everyone involved.
And before we dive into the history, let's preview those aha moments for you, the listener. We're going to dissect the sheer magnitude of their portfolio churn, shedding that $585.1 million in older assets while pouring $434 million into new build-to-rent projects in places like North Carolina. This pivot is a perfect mirror of current REIT strategy.
But the real kicker is the legal side. I mean, we really need to fully unpack the specifics of these antitrust suits. This isn't traditional price fixing like you might imagine. The allegation is that proprietary data fed into a shared algorithmic software created a mechanism for collusion, and that it impacted millions of renters. That intersection of, cutting-edge technology and ancient antitrust law is really where the future of housing regulation is being decided right now.
Okay, so let's ground ourselves in the basics then. What exactly is an entity like Avalon Bay? We mentioned it's a REIT, a real estate investment trust, headquartered in Arlington County, Virginia. But what does that specific structure actually mean for how the company operates and why they have such aggressive growth mandates?
Well, a REIT, at its core, is a company that owns and usually operates income-producing real estate. They're required by law to distribute at least 90% of their taxable income to shareholders annually, usually as dividends. So this structure, it essentially allows people to invest in real estate assets without actually, buying and managing the properties themselves.
So the pressure is always, always on revenue generation. Because they have to pay out those dividends, they need constant, reliable income streams and, of course, growth.
Precisely. And the size of the revenue stream Avalon Bay generates is, well, it's staggering. Their 2020 revenue was $2.1 billion US. And while revenue is one metric, just look at the growth trajectory and profitability. By 2022, their operating income had jumped dramatically to $1,765,786,000. That's a massive margin. It just demonstrates their efficiency and their scale.
And their capital base, I mean, this is what gives them the muscle for those multi-billion-dollar deals we're going to discuss.
Absolutely. The total assets the company reported in 2020 stood at $19.199 billion. That nearly $20 billion asset base is the foundation that allows them to absorb major risk, develop massive new projects simultaneously, and execute those sweeping strategic portfolio moves we'll get into later. When you have nearly $20 billion in assets, you are not just reacting to the market. You are shaping it.
And this scale, it wasn't achieved overnight. The origin story is a classic case study in corporate consolidation, right, Day? It dates back to 1998, when the current company was formed through a major growth by merger.
It was two very distinct entities coming together, each with its own history. The first was Avalon Properties, Inc., which itself was a relatively new player. It was spun off in 1993 from the massive Trammell Crow Company, which is a storied name in commercial real estate development. Avalon Properties, led by Richard Michaud and Chuck Berman, was already a sophisticated corporate entity.
And the second piece brought the grassroots, the operational expertise.
That was Bay Apartment Communities, Inc. This business had a much longer history, built on the residential apartment operations established way back in 1978 by a guy named Mike Meyer. So the merger in 1998 brought together the financial power and development legacy of a major corporate spinoff with a deep, decades-long operational knowledge of a successful apartment manager.
And the resulting entity, AvalonBay, was immediately a giant.
Immediately. At the time the merger closed in 1998, the new company owned 40,506 apartment units. That's an instant, powerful concentration of assets right there.
Wow. And from there, they used that foundation to focus on specific markets.
Very specific markets. They leveraged that foundation to focus heavily on the high-cost, high-density coastal markets. Think of the places where land is scarce and rents are sky high. As of January 2021, their portfolio was heavily concentrated in New England, the New York City metro area, the Washington, D.C. metro, Seattle, and all throughout California. They positioned themselves as the premium choice in the most desirable and most expensive urban centers in the country.
That focus on premium coastal assets made them the company they are today, but the moment that truly catapulted them into, the rarefied air of a housing behemoth, shaking up the entire industry, that was the 2013 Archstone acquisition.
This is a milestone that really deserves some context. The Archstone deal was seismic. Archstone was a colossal portfolio of high-quality apartment communities, but it was being held by Lehman Brothers. And as many listeners will remember, Lehman Brothers collapsed during the 2008 financial crisis. For years, Archstone had just been in limbo.
So this wasn't just an ordinary business purchase. This was a post-crisis opportunity to grab massive prime assets that had been tied up in bankruptcy proceedings for years.
Exactly. It was a once-in-a-decade opportunity for consolidation. So on February 27, 2013, AvalonBay Communities partnered with another major REIT, Equity Residential, and together they executed a staggering $9 billion deal to acquire the entire Archstone portfolio.
Wait, a $9 billion deal? That's incredible. What did that acquisition actually achieve for AvalonBay?
It achieved three things instantly. First, sheer scale. It added thousands of prime, already stabilized units to their portfolio. Second, it eliminated a major competitor and consolidated ownership in key markets. And third, and maybe most strategically important, it absorbed Archstone's critical development pipelines. Archstone had been working on these high-potential projects, and AvalonBay instantly took over the reins of those future developments. It wasn't just buying buildings, it was acquiring future growth capacity. That deal single-handedly cemented their position among the nation's absolute top apartment owners.
It perfectly illustrates how these REITs use their massive capital base. They wait for a moment of financial distress or structural opportunity, and they can just reshape the entire urban real estate landscape overnight. So fast forwarding to today, or specifically September 30, 2025, how does that history translate into their current operations?
The scale is just, well, it's breathtaking. As of that date, the company owned or held interest in 314 apartment communities, containing a total of 97,219 apartment homes. They are right on the verge of hitting that 100,000 unit milestone. And crucial to their future strategy, they have 21 additional communities currently under development.
That development pipeline, it just speaks volumes. It's not a static company sitting on its assets. It's an aggressively expanding empire, constantly pouring money into the next cycle of growth.
It is a constant, aggressive search for market dominance or at least maximize penetration in their target regions. And just to complete the picture, we should recognize the core leadership guiding this strategy. You have Timothy J. Naughton, who serves as chairman, and Benjamin Schall as the CEO.
And we noted a very recent corporate governance update, which highlights how seriously they take optimizing their leadership structure.
Yes, in November 2025, they appointed Connor C. Flynn to the board of directors. A large, complex entity like AvalonBay is always looking to integrate top-tier expertise to navigate both the financial markets and, the increasingly complex legal and regulatory environments we're about to discuss. The constant need for optimization and repositioning, driven by the demands of the restructure, is really the engine behind their aggressive business model.
Having established that massive $19 billion foundation, we now pivot to what they're actually doing right now with that capital base. The movement of money in Q3 2025 was profound, and it signaled a major intentional shift in where AvalonBay sees its future returns.
Here's where it gets really interesting. The overarching strategic direction, which was confirmed after their 2024 third quarter earnings call, is a clear statement of intent. They are focusing more resources on build-to-rent development and acquisitions, and this is a crucial pivot for a company historically synonymous with dense, pricey coastal markets.
When you say build to rent, what does that strategy generally imply? And why is it so attractive now compared to, say, buying existing properties in Manhattan?
Build-to-rent often targets suburban or emerging urban areas where land is cheaper, regulatory hurdles might be lower, and construction costs are more manageable than in the core gateway cities. In a place like San Francisco, you might struggle for years to get permits and face massive construction costs only to deal with rent control. But in a build-to-rent market like Durham, North Carolina, you can execute development faster at a lower per-unit cost and enter a market with strong economic tailwinds but potentially fewer regulatory constraints on pricing. It's about building new supply where the margins are highest.
That shift is perfectly illustrated by the specific Q3 2025 activity. They completed one major project and started two new ones, representing a huge commitment of capital outside their traditional strongholds.
The numbers are incredibly illustrative of this strategic focus. The new development activity included the completion of a substantial 508-unit community in Annapolis, Maryland. That's hundreds of units immediately coming online and generating revenue. But the real tell is the location of the new construction starts. They broke ground on two new communities, one in Durham, North Carolina, and one in San Diego, California.
And the capital dedicated to these projects, the ones either just completed or just started, totaled a significant $434 million. That's not just renovation budget. That's nearly $500 million placed as a specific bet on these high-growth, often secondary or tertiary tech and job markets.
And that $434 million investment is fascinating when you compare it to the source of their capital. This massive development strategy is being facilitated by significant asset sales, the repositioning we keep mentioning.
Let's dive into that asset churn. It's a striking figure. In Q3 2025, they sold 6 wholly owned communities, bringing in a combined $585.1 million. They are clearly shedding capital out of assets they deem less strategic.
When a REIT sells assets worth well over $500 million in a single quarter, it's not routine maintenance. It's a deliberate tactical move to restructure the portfolio. They are looking at stabilized, often older properties, likely properties that have peaked in value in mature markets like the D.C. or California metros, and saying, the return on capital here is maximized. Let's cash out.
So they are harvesting the profits from the slow-growth, mature investments to fund the high-growth, high-return development pipeline. It's a very smart use of capital.
It is the essence of smart REIT management. They are taking capital out of areas with increasing regulatory risk or where property taxes and operating expenses might be cutting into margins and redeploying it into new construction where they control the building costs, control the design, and can target favorable market conditions.
But they weren't just building and selling. They were also acquiring in those key growth markets to diversify their immediate revenue streams.
That's right. In addition to the sales, they acquired 3 new communities during that quarter, further emphasizing this pivot. Those acquisitions were in Charlotte, North Carolina, Coconut Creek, Florida, and Redmond, Washington.
Let's analyze the geographical implications here. You've got Durham and Charlotte in North Carolina, major banking and R&D hubs. You have Coconut Creek in Florida, a strong Sunbelt growth region, and Redmond, Washington, which is the heart of the tech sector outside of Seattle. This is a very targeted strategy, isn't it?
This is the definitive insight into the post-pandemic REIT playbook. They are looking for markets characterized by three things: high job growth, favorable demographics, lots of new residents, and critically, a low regulatory risk profile.
So, markets that are less likely to implement strict rent control or cumbersome tenant protection laws, which can cap their revenue growth.
Exactly. They are moving into states like North Carolina and Florida that have historically been less aggressive with tenant regulations than, say, Massachusetts or California. By developing new product in these regions, they position themselves to capture high rental rate growth without the structural risk posed by existing rent caps in older core markets. The $585 million in sales from older assets essentially funds their next decade of dominance in the Sunbelt.
It's fascinating how a company of this scale is constantly optimizing its physical location based on microeconomic and regulatory environments. But this aggressive, profit-driven strategy, while successful on paper, brings us straight to our next point. When maximizing shareholder value is the absolute priority, the pressure to maintain rents and returns can lead to practices that cross legal boundaries, which is exactly what their current antitrust woes suggest.
That's the crucial link, and one we need to keep in mind. The same pressure driving them to sell $500 million in assets and bet $434 million on new construction is the pressure that could lead to the alleged misconduct detailed in the following sections.
We've established the massive foundation and the sophisticated strategy. Now we shift to the high-stakes legal battles. We're moving from balance sheets to alleged bad faith. This section focuses entirely on the high-profile legal battles concerning rent pricing mechanisms, and it revolves around a key piece of technology: revenue management software.
This is arguably the most significant legal threat facing the entire institutional landlord sector today. The focus is RealPage, a software designed to optimize revenue, which has become the centerpiece of widespread antitrust lawsuits. The core allegation is that AvalonBay, alongside other major landlords, used this software to engage in an unlawful conspiracy to fix or inflate rents.
I need you to unpack that mechanism for our listeners. We've heard the term algorithmic collusion. How does technology designed for efficiency allegedly become a tool for illegal price fixing?
It's a fundamental misunderstanding of competition, according to the complaints. Think of it this way. In a competitive market, you have 10 major landlords, and they all keep their pricing strategies, their occupancy rates, and their future plans secret from one another. They set their prices independently based on their own operational costs and market observations. That's true competition.
But with this software, that secrecy allegedly just evaporates.
Exactly. The claim is that when all 10 competing landlords feed proprietary, competitively sensitive data details on lease turnover, pricing elasticity, and real-time occupancy into a single, centralized, third-party algorithm like RealPage, that algorithm now possesses a collective view of the market that no individual landlord should legally have access to.
So if the software knows everyone's occupancy and everyone's desired return, it can calculate the single highest optimal price that the entire collective can charge without sacrificing occupancy too much.
Precisely. And the specific charge across multiple jurisdictions is that by consistently following the algorithm's recommendation, which is always geared toward maximizing collective revenue, the landlords allegedly agreed to set rents at artificially high or super competitive levels. This violates federal and state antitrust laws because it mimics a cartel or a coordinated effort without the need for a single email or meeting between human executives. The algorithm becomes the alleged coordinator.
That's a huge distinction. It moves price fixing from the smoky backroom to the centralized server. Let's look at the state-level action, starting with New Jersey, which took definitive action in April 2025.
The New Jersey Attorney General filed a very specific lawsuit against AvalonBay and 9 other major landlords over this exact scheme. The complaint argues that the collective reliance on RealPage and the sharing of proprietary data fundamentally broke competition across the New Jersey rental market. The AG's office is alleging that this mechanism directly resulted in inflated prices for millions of renters across the state. This is treating algorithmic recommendations as a form of conspiracy.
And the New Jersey action signals that state regulators are taking this modern form of alleged price manipulation extremely seriously. But New Jersey isn't the only major jurisdiction acting. The Washington, D.C. Attorney General also filed a similar, highly publicized antitrust suit.
Yes, and the D.C. case has a particularly telling procedural history that signals its underlying strength. Initially, an earlier complaint filed by the D.C. Attorney General was dismissed by the court. But critically, that dismissal wasn't a complete legal victory for AvalonBay. The court allowed the district to amend and refile its claims. And this signaled that while the initial complaint may have lacked some necessary technical or factual detail, the legal theory that this algorithmic mechanism is anti-competitive was viable enough for the court to greenlight a second attempt.
And the update from September 2025 is the immediate high-stakes risk that we mentioned in the intro.
It is the most significant indicator yet of legal risk. In September 2025, a D.C. Superior Court judge rejected AvalonBay's motion to dismiss the amended claims. This is a massive legal setback for the defense.
For our listeners who aren't familiar with legal jargon, why is the rejection of a motion to dismiss such a critical event?
A motion to dismiss is essentially the defense team arguing, even if everything the plaintiff says is true, it still doesn't constitute a legal violation. End quote. When a judge rejects that motion, they are saying, no, the plaintiffs, in this case, the D.C. Attorney General, have put forth enough factual evidence and established enough legal grounding that this case must proceed to discovery and potentially trial. End quote. It opens the door to forced evidence sharing, depositions, and a very expensive high-stakes legal battle where AvalonBay will have to defend its pricing mechanisms under intense scrutiny. This signals the immediate palpable risk to the company's current operational model.
That reframes the entire discussion. If the fundamental way they price their units is now under threat, that could have enormous financial repercussions for a REIT that relies on predictable revenue growth. Let me play devil's advocate for a moment, though. If RealPage merely analyzes publicly available market data like comps, vacancy rates, neighborhood growth, and suggests a price, how is that different from what a highly paid human executive would do?
That's the core legal battle being fought. The counterargument, and what the source material points to, is the sharing of the proprietary, non-public data. A single, independent human executive can look at public comps, but they don't have real-time access to the occupancy rates and future pricing intentions of their competitors. The complaint alleges that the platform acts as a centralized database and recommendation engine, creating a level of coordination that traditional antitrust law was designed to prevent.
So the issue isn't optimization itself. It's the shared and sensitive input data used to feed that optimization that crosses the legal line.
Exactly. If these lawsuits succeed, and the D.C. ruling suggests that the courts are open to this modern legal theory, it will fundamentally reshape how large institutional landlords are legally allowed to price their units and what data they can share. This litigation challenges a basic assumption of independent price setting in the modern, algorithmically driven apartment industry, and it puts pressure directly on the financial results of REITs like AvalonBay.
We've tackled the corporate scale and the systemic risk from the antitrust battles. Now, we must bring the discussion down to the human level. This section details lawsuits that demonstrate the alleged impact of AvalonBay's practices directly on individual tenants, covering claims of housing discrimination and consumer fraud.
This contrast is, it's jarring. We move from discussing billions of dollars in asset trades to discussing basic housing dignity and compliance. These cases allege violations that strike at the very core of tenant rights. We can start in Washington, D.C. with a powerful case study involving discrimination.
This is Case Study 1. Housing discrimination at the AVA Noma property in D.C. In June 2025, the Equal Rights Center, or ERC, sued the company. What was the central and really shocking allegation here?
The core allegation centers around a seemingly simple compliance issue: windows. The ERC claims that since at least 2020, the AVA Noma property advertised units by listing windowless rooms as bedrooms.
That seems like such a clear, easily avoidable violation. Why does the lack of a window in a bedroom matter so much legally?
It matters deeply because the D.C. Housing Code is explicit. This is a safety and habitability requirement, ensuring light, ventilation, and emergency egress. But the violation takes on a discriminatory dimension when you consider housing assistance programs.
Because housing voucher programs require units to pass certain compliance checks before they can be leased.
Precisely. The local housing voucher program requires units to pass an inspection, and that inspection strictly enforces the window requirement. By allegedly advertising these non-compliant windowless spaces as bedrooms, AvalonBay was, in effect, misleading the public and taking those units out of the accessible pool for people who rely on housing vouchers.
So it's not just a technical violation, it's a structural barrier to housing access for the most vulnerable populations.
That's the crux of the ERC's complaint. They allege that this practice made a significant portion of the building's units unavailable to tenants using housing vouchers, thereby constituting illegal discrimination under D.C. law. And here is the truly shocking detail from the source material. 100% of the advertised three-bedroom units were impacted by this alleged windowless room issue.
100%. That means if you were a larger family needing a three-bedroom unit and relying on a voucher, that building was entirely inaccessible to you.
That's the alleged discriminatory impact. It shows how easily a technical violation misclassifying a room can translate directly into a major civil rights and equity issue, systematically shutting out people with public assistance from accessing specific, desirable housing stock in prime locations like the Noma neighborhood. This case highlights the crucial role housing code plays not just in safety, but in accessibility.
What a stark contrast to the $434 million they're investing in new construction. Now let's move to case study 2, back in New Jersey, where the focus is consumer fraud allegations at a property called Avalon Teaneck.
This case alleges a classic economic exploitation tactic, a true bait-and-switch scheme. The complaint claims that AvalonBay lures tenants in with attractive market-rate initial rents, making the property seem highly competitive and a great initial deal.
But the bait-and-switch happens when it's time for the tenant to renew their lease.
Exactly. When the lease expires, the tenant is allegedly hit with substantial, undisclosed renewal premiums that drive the final rental price significantly above the current market rate for comparable units. The complaint is built on the idea that this is an intentional scheme designed to exploit tenant inertia.
And tenant inertia is a very real factor in the housing market. I mean, moving is expensive, it's stressful, it's time-consuming.
It is the exploitation angle the complaint focuses on. They allege that AvalonBay leverages the inherent inconvenience, high cost, and disruption of moving, finding a new school, paying new deposits, hiring movers to push through these inflated renewal rates. Most people, faced with that monumental friction, will simply pay the premium, even if it's far above what a new tenant might pay or what the market truly demands.
It's leveraging their existing tenant base as a captive audience for maximizing profit under the pretense of competitive pricing. What is the current legal status of this Teaneck consumer fraud case?
The court, as of October 2025, granted in part and denied in part AvalonBay's motion to dismiss the lawsuit. Critically, the denial means the court allowed the core parts of the consumer fraud case to move forward. This suggests the allegations regarding the bait-and-switch pricing and the undisclosed premiums hold sufficient legal merit to warrant a full legal review. Much like the D.C. antitrust case, this denial is a major green light for the plaintiffs.
Before we move to our conclusion, we should briefly mention a piece of historical tenant litigation that speaks to another core responsibility of a landlord of this magnitude, the duty of care regarding physical safety.
That would be the 2017 settlement of the class action lawsuit filed by former tenants of Avalon at Edgewater, New Jersey. This followed the catastrophic 5-alarm fire in 2015. The core allegation was that AvalonBay breached its duty of care by violating fire standards and safety procedures in the building's construction or maintenance.
And that class action settlement was approved in 2017. It's a sobering historical reminder that while much of the current litigation focuses on sophisticated pricing and financial practices, the fundamental responsibilities of a massive housing provider include ensuring basic life safety and compliance with physical building codes. When you manage nearly 100,000 homes, the risk and the corresponding duty are immense. So what does this all mean? We've covered everything from a $9 billion corporate deal that reshaped the industry to alleged discrimination resulting from a missing window and algorithmic pricing models facing antitrust claims.
What this deep dive reveals is a company, AvalonBay, defined by a deep and inherent tension. On one hand, they operate as a sophisticated multi-billion-dollar REIT, relentlessly executing complex, forward-looking strategies designed solely to maximize shareholder returns. They are adapting quickly, shedding $585 million in older assets to reinvest $434 million into high-growth, lower-regulation markets like North Carolina and Florida. That is financial ingenuity at the highest level.
But on the other hand, the legal challenges suggest that the pressure to deliver those returns may be fueling behaviors that strike at the heart of fair market practices and housing accessibility. The antitrust claims in New Jersey and D.C. are challenging the very architecture of modern rent pricing, risking a fundamental change in the economics of the multifamily industry.
And then you have the consumer-level claims, the AVA Noma case about windowless rooms systematically making units inaccessible to voucher holders, and the Avalon Teaneck bait-and-switch scheme that exploits the friction and exhaustion of moving. These ongoing cases force a public reckoning regarding whether a company of this size is prioritizing maximizing profit margins over basic legal and ethical obligations to its tenants and the community.
So for you, the listener, why is tracking the operations and legal battles of a company like AvalonBay so critical? Why should we care about the inner workings of the third largest apartment owner?
Because they are, in effect, the standard setter. Their decisions shape the U.S. housing market for everyone, whether you rent from them or not. Where they choose to build dictates development patterns, how they are legally allowed to price their units since the ceiling for rent levels across entire metros. And the outcomes of these high-stakes lawsuits, especially the algorithmic collusion claims, will redefine tenant rights and legal conducts for every major landlord in America. When the dominant players are constantly in litigation over alleged price fixing and discrimination, it's not isolated news. It's a leading indicator of systemic pressure points in housing affordability and access.
It provides a window into the trade-offs being made at the highest levels of corporate real estate. And the discussion about the AVA NOMA property, the windowless rooms, and their alleged impact on housing voucher availability raises a final provocative thought for you to mull over as we conclude this deep dive.
Yes, this situation forces us to question a critical distinction in the housing sector. How does a large housing provider define value and compliance? Is compliance with housing code like having windows and bedrooms simply a cost to be minimized or strategically avoided through misleading advertising, perhaps because providing lower quality units increases investor returns? Or is it a non-negotiable standard to be upheld, especially when the failure to comply systematically bars vulnerable, subsidized populations from access? The answers emerging from these high-stakes lawsuits will ultimately define not just AvalonBay's future, but the standards of corporate conduct required of every dominant landlord operating in America today. That is the true impact we will be tracking.